going to jump in and we're going to do tariff talk. President Trump had the switch on blast Monday and Tuesday. Then they took the switch off on Wednesday. The markets have responded, as one might guess, up in unbelievably on Wednesday, but down every other day this week. What's your read on sort of, kind of where we are with tariffs at this point? And what should we be looking for next?
Well, the first thing is, how will tariffs affect the U.S. economy? And it's not just going to be the sectors and companies that import goods from Mexico, Canada, China, et cetera, et cetera. It's ultimately it's the consumer. It's the consumer. The consumer facing higher prices will slow down their discretionary spending first. We're talking about restaurants. Restaurant spending is down, which, by the way, we'll talk about that in our show on the week ahead in economic activity, right? So you're going to get some luxury and non-essential purchases. They're going to take a big hit because they're 2 to 3 times more price sensitive than necessities. All industries will be affected, right? It's not just the tradable sector, but also the non-tradable sector because of the impact on the consumer. And what does it mean for businesses? Well, it means, when in an environment where consumers just don't have the firepower to go out and continue to spend, right? Remember, excess savings down, stock markets crumbling, right? Falling apart. You have a consumer that's afraid, a consumer that's, we got consumer expectations, inflation expectations coming that came out today. The consumer is expecting higher prices. The consumer is expecting economic growth to slow. The consumer is afraid, about, whether or not they'll be able to keep their jobs. And so you have a consumer that's not going to be able to take the price increases. Yeah. Profit margins, companies will not be able to pass on those price increases to consumers. Profit margins are going to crack, are going to shrink. And of course, it means that, you can't have businesses cannot invest, into the future. Even with the reprieve we got, right? So like the pause, if I don't know where things are going to be 90 days from now, how do I hire more workers?
Well, let's talk about that, because I mean, the tariff, if you've been following along, and I mean, this, for the average news consumer, there's where are we on this time horizon, I think has become confusing, because, there was the quote unquote Liberation Day where the tariffs were announced. And that was now, this show will be airing during the week of the 14th. That would be 2 weeks ago from then when you get to hear this. And then Trump on Wednesday announced the pause on implementation of the full, sandwich board of tariffs that had, where every country had a different. So here's where we are right now. Just to level set this, this is as of Friday, April 11th at 9:18 a.m. Eastern time, Central time. 145% duty on all goods from China. Okay. 25% tariffs targeting aluminum, automobiles, and goods from Canada and Mexico that are not under the United States-Mexico-Canada agreement, or the so-called USMCA. And then a 10% tariff on all other imports coming in. That is it. And it's in its entirety right now, and during this pause. I mean, we're talking about we're talking about luxury goods. I mean, China luxury goods, is that kind of really where that comes from? I mean, this is very much pointed at right now at China. And there are people that are talking about the fact that this was the strategy, that this was President Trump's strategy all along.
I mean, look, I'm not going to talk about we don't know what his strategy was.
And I'm not trying to pull you into any kind of a debate or criticism or anything like that.
I definitely don't want to speculate on what the president or the administration is doing or not doing. I can only tell you that it doesn't matter if you're imposing tariffs on Chinese goods only, that if you double the price of Chinese goods, all those consumers that are buying those cheaper goods, which by the way, are going to be lower income households, right? They're going to feel it. And the big question is, will they be able to absorb the price increase? And if they're not able to absorb the price increases, then they're going to spend less on everything else. There's also the fact that a lot of, those goods, right? They're not just finished goods. A lot of parts go into the manufacturing sector, the process. A lot of the stuff goes into other goods, that are then, finished and consumed by Americans. People talk about Apple's exposure and Nike's exposure. I mean, a lot of goods end up in supply chains, in the process, right? In the production process, in production networks. And then they end up here, right? And unfortunately, the companies that make those goods will not be able to pass on those price increases to consumers. And it's going to hurt. But look, besides that point, financial conditions are tighter, right? We're seeing bond prices rising, yields rising. At the same time, stocks are falling. And so you have tighter financial conditions that are going to cause businesses to pull back, whether it's the price of their goods, the cost of goods, whether it's the ability to borrow cheaply in order to invest and expand their operations. That's gone. And unfortunately, it means consumers will also pull back. It means the economy will continue to slow into the year ahead. I think that's what and then if you want to talk about whether or not the administration's great plan was to get Fed rate cuts, because I've heard that too. Well, actually, if you cause a ton of uncertainty, if you cause a tightening of financial conditions, and economic growth is slow, then yes, of course the Fed will have to step in, right? The Fed might be on pause for now, but the Fed will have to step in to rescue the U.S. economy at some point. But I don't think that's what, I don't think that's what people want, because it doesn't mean stocks are coming back up. I think a lot of people think, oh, we're going to get some rate cuts and maybe the stocks are going to bounce back up. But there's no way stocks are coming back up if people really believe the U.S. economy is in trouble and that, growth could contract. And so I think that's the problem with that logic. If investors begin to suspect that economic growth could actually contract, then coming Fed rate cuts are not going to have the impact of boosting the stock market. And so I think that's where people are kind of wrong. If we get a slowdown, great. If we get a contraction that we're in trouble, then we can't look to Fed rate cuts to prop up the stock market.
Yeah. Well, I appreciate your thoughts as always. We'll call it good there. This is a conversation that you and I are going to be having, I think, quite often, in particular over these 90 days. Last thought on this, just to kind of balance it. China, retaliated against, the administration's 145% tariff with a, 125%.
Well, look, what? It's going to hurt the Chinese economy just as well, by the way. I think it's important to say that these trade wars hurt everyone,